Happy Tuesday out there, Team 42. It's your skipper here, Darius Dell, to present our macro minute for Tuesday, August 20th, 2024. Hope everyone's having a great summer. As always, we'll start with the executive summary from today's lead-off morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to stay on the right side of market risk, you need to be a client of 42 Macro. So today's key macro questions are, is the rally in stocks running out of steam? Our answers are, the answer to that question is hard to ascertain unless you're relying on reliable quantitative risk management tools like the 42 macro positioning model, which signaled a high probability of a correction in risk assets over a short to medium term time horizon at the year-to-date high in the spot. With the median Wall Street strategist calling for roughly 5% more upside in S&P 500 through year end, it is comforting to know that our positioning model is signaling only low risk of a correction in stocks over the short to medium term, which in our risk management nomenclature is 1 to 3 months. In our August 17th Around the Horn, we detailed the macro risks we see materializing in the first half of 2025. It is, however, August, so investors should respect the x-axis on those processes. The path of least resistance for risk assets remains higher in the likely absence of a sharp, surprising, and protracted slowdown in growth, a sharp, surprising, and protracted acceleration in inflation, or a sharp, surprising, and protracted tightening of monetary and/or fiscal policy, usually both. FYI, those are the three primary reasons for trending risk-off market regimes, in part because they each contribute to declining global liquidity. Neither outcome seems likely through year end. Transitioning to our 42 macro dashboard here, as always, we'll wrap up with a question from our community. This one's regarding the Senior Loan Officer Survey data. Great question. So I'll read it verbatim here. It says, Didi, curious on your thoughts, given the SLOOS data showing an acceleration in declining lending standards. Do you think this could be a sign of a possible re-acceleration in growth coming in the first half or the second half of 2025? So the answer is yes. We'll talk about that why later. It is. I understand it is far off, but I've always seen the credit cycle as a leading indicator of the business cycle. And with all the talk of a slowdown, which I generally agree, I've been going back to that data point since its release, consistently scratching my head. So we don't agree that the credit cycle is a leading indicator of the business cycle. In fact, the data itself does not agree with that. Credit card delinquencies, all those kinds of things, delinquencies in general, and charge-offs are a lagging indicator of the broader business cycle. In fact, they're one of the last indications of the business cycle, last cycle within the business cycle to break down or break down in a heading into a recession, break out coming out of a recovery. But there are leading indicators within the credit cycle, specifically persistent leading indicators within the SLOOS data, which we'll talk about shortly, that are leading indicators of the broader business cycle. So the credit cycle broadly, if you look at the broad variety of metrics that we use to track and monitor the credit cycle, most of those time series are lagging indicators, but there are a very few handful of indicators within the credit cycle that are persistent leading indicators of the business cycle, which means that they lead on the way down and on the way up. We'll talk about that in shortly. So getting back to the question, it says, I don't know if the team has looked into the historical circumstances where the credit cycle has re-accelerated into a slowdown or credit cycle head fake and what the implications of that might be. Just thought it was interesting and wanted to share. So appreciate all that you do. So if you indulge me, I'll transition to this chart where we show the Delta Adjusted Z-score for the Senior Loan Officer Survey data. This is the net percentage of respondents easing consumer loan standards. The reason that it's first in the legend is because that is the longest leading indicator from this particular cohort of indicators, followed by the net percentage of tightening, net percentage of respondents tightening standards for C&I lending standards for small firms, and then followed by the net percentage of respondents tightening C&I loan standards for large and mid-sized firms, followed by growth. So the order of those indicators in this chart and in all these business cycle charts that we compile for our clients here, 42 Macro, indicates the order in which the indicator leads or lags the other indicators in the chart. So as you can see, the longest, the three leading indicators, the ones that lead growth in this particular chart, are in a moderating downturn. That means they're below trend, but they're accelerating. The growth is currently, I wouldn't say moderate. It's, kind of relative to the early part of this year. It's kind of in a moderating upturn. So if you would expect as an investor, you should expect as an investor that given that the three lines down here at the bottom lead growth, you would expect growth to catch down to them over the medium term. Now, if those things continue to improve, that suggests that growth, it may not catch down as far as they currently are. However, if they kind of flatten out and stay where they are, you would expect, again, over the medium term, growth to catch down to those indicators. And this is, one of those things. So essentially saying growth is outperforming these particular leading indicators with the credit cycle, specifically on the lending standards amongst the Senior Loan Officer Survey. So the reason those indicators are in the order that they are is we did a big deep dive empirical study that studied all of the post-war business cycles, so across hundreds of time series, to identify which time series across the various cycles that comprise the business cycle, of which there's policy, corporate profits, liquidity, growth, the market cycle broadly, employment, credit, and inflation. Those are the kind of 8 main cycles in the business cycle, and they kind of break down and break out in that order, generally speaking. So what we did was we looked at all the various indicators, dozens of indicators within each of those cycles to identify which things lead those things, which obviously give us a lot of, kind of high potent signal for where we are in the business cycle, which is obviously incredibly important to know as an investor. So what this chart here shows is the showing the trailing 10-year delta adjusted z-score in months before and after a recession begins for each of these indicators, with 0 being the start of a recession. And so each of these plots represents the median path that each of those indicators takes heading into a recession, into the early part of recession. So as you can see, on a median basis, the net percentage of respondents easing consumer loan standards breaks down, let's call it 15 months ahead of a recession, i.e., so the net, so the delta adjusted just means the indicator is inverted to account for its impact on the business cycle. So things like unemployment rate or jobless claims are going to be inverted so that they go down, heading into recession, just to make the chart look more easy to read. So this particular indicator within the Selenium Loan Officer Survey is the longest leading indicator heading into the downturn, followed by the net percentage of respondents tightening C&I loan standards for small and large size firms. And as you can see, those things both lead growth. Growth tends to break down durably below trend, roughly around 6 months ahead of a recession, whereas these indicators break down durably below trend, roughly around, let's call it 12 to 15 months ahead of a recession. The opposite is true in a recovery. So when you see these indicators, so this is the same analysis, but looking at from the perspective of a recovery. So 0 in this chart means the beginning of the business cycle. And again, we're studying all the post-war U.S. business cycles. I want to say there have been about 12 of those in the sample. And so the median path that these indicators takes into a recovery is these things kind of break out durably above trend. Let's call it 6 to 9 months ahead of after a recovery has started, and then growth breaks out durably above trend. Let's call it about 12 months after recession starts. And so you got about a 1 to 2 quarter lag between these indicators improving and growth starting to improve. And so taking us back to where we are here, these things are all still below trend, i.e., they're contributing to downward force on the business cycle, even though they're improving, they're still contributing downward force on growth. That just means they're contributing less downward force on growth than they have been in previous quarters. And so again, we expect growth to trend down, but just given that these things are a kind of a 1 to 2 quarter lead in business cycle upturns on growth, it suggests that we're probably not going to slow all the way into a recession with respect to growth. The slowdown we and other investors are expecting in growth over the medium term. So it does suggest, going back to the question, it does suggest that we could see a reacceleration in growth sometime in 2025, at least according to our model projections, that'll likely be in the second half of 2025, because we see growth trending lower between now and through the first half of 2025. So if you want to check out the analysis that supports those conclusions, obviously you know where to come find us, and we appreciate you for tuning in. Back here tomorrow. Cheers.